Hi, welcome to the market born by Aging Markets. And this is starting by 4 p.m. So I try to keep to time here. We have a couple of people on here today. We have our guest with us, Eronmonsele Aziba. I hope I pronounced that properly. Pardon me. So the market born is an event that is tailored towards what is currently happening in the global market space. And the value here we're giving to our viewers is we try to help you understand the global climate from experts like the guests we have here up, and expert opinions, insight, and market intelligence that you can use to structure your portfolio, either you are investing or you are trading, right? So there are opportunities for you to capitalize in the market. So he'll be sharing with you some of his experience if he has had over the years about the market. He's a market expert in his field. So I'll just leave the floor for him to introduce himself and we will get the program going. So over to you, Mr. Emerson.
All right. Thank you very much. Good evening. And thank you once again for having me. First, I'd like to confirm that you can hear me.
Yes, I can hear
Okay.
you. Let's go. Yeah.
All right. Thank you very much. So my name is Eronmonsele Aziba. I currently work as an investment manager with a firm here in Lagos. What I do on a day-to-day basis, so I manage a couple of locally listed mutual funds that have an exposure to both the fixed income market and the equities market. In addition to that, I also manage a couple of proprietary equity portfolios for my firm. And my specific focus is on the equities market, um, the Nigerian equities market. But also in past, I've also covered markets across sub-Saharan Africa. So I would say I have a well-versed knowledge of the financial markets here in Africa and globally, and the interplay between these markets. So once again, thank you very much for the opportunity, and hope to have a
Mhm.
good conversation.
Thank you for that. So just to kickstart what we're talking about today, during your introduction, I overheard you talking about your understanding about the global market is um, globally sub-Saharan Africa, and you also manage fixed income portfolio, right? So you're very vast, and you cover a good number of assets from the fixed income to the equities, and you have an understanding of what the current global market is about. That's why we have you here today. So just to start off the program and to give our guests an understanding of what's currently happening. So if you look at the current trend in the market, we've been in a bearish market because a majority of global assets now have done more in a negative, more than 20%, because I know after 20% is when we are officially in a bearish market. So would you like to give our audience a good understanding on where we are currently in the global market, how we got to where we are, and your outlook for the future?
All right. Thank you very much. Once again, um, the downturn in market that we're starting to see is largely due to the sort of bearish sentiment that investors are having towards the global economy. And one of the major drivers of this sentiment is the soaring inflationary pressures that we've seen, across the global markets in the US, the UK, across the rest of Europe. So what that is then doing is that we're seeing increased pressures on consumer spending. And when that starts to happen, there generally just seems to be this trickle down, bearish view about the entire economy and about the financial markets. And what you then have is investors, with all the uncertainty that is then surrounded around that, you have investors trying to move to more safe haven, to more safe haven assets. Like I mentioned earlier, we've seen inflationary pressures be the major the major driver of the current bearish sentiment that we're having. The question would then be, why are we seeing such pressures? Global inflation, global inflation rising. Um, we've a lot of the rising inflationary pressures that we're seeing has been closely tied to the sort of energy crisis that we're having. Now the what is causing the energy crisis? Again, that's also now closely tied to the conflict that's currently going on between Russia and Ukraine. The fact that we have Russia being one of the major suppliers of energy, especially gas, to Europe and the bulk of the global markets has been one of the major drivers of inflationary pressures, because we're aware that since the conflict started, we had a lot of these global economies start to impose some sort of sanctions on the Russian authorities, business activities with Russia. We've even seen some companies take the step of closing down their Russian operations, and in some sort of retaliatory manner, we saw Russia then say, okay, cool, you know, um, we control a lot of the energy supply
Yeah.
that you economies need, so we're just going to
Mhm.
jack up the price, right?
Yeah.
Um, and because there's still a lot of dependence, on gas from Russia, especially across the rest of Europe,
Yeah.
we've seen that's now trickled down to the higher costs of the higher costs of production, which has then trickled down to um, the actual cost of the finished goods. So it starts from energy. Price of energy has gone up. So you, as a producer, for instance, your cost of production has gone up because you've seen energy costs go up. What you then try to do is pass as much of that hike in production cost down to the price of your finished good. And then me, as the consumer who's coming to buy, I realize that this thing that was $1 before is now $1.50. So I'm spending more on purchasing this good, and we've seen that across a number of goods, and that is what has been the major factor driving inflationary pressures um,
So, 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 so,
across
so
across
yeah.
global markets.
So just to chip into what you were talking about. So what you're trying to tell us now is a majority of the pressures that we're seeing in the world globally with regards to inflation. Obviously, the COVID period also added to this inflation. Now, the Russian and Ukraine crisis then topped it up. So, if we look at what has been happening globally, when we look at the inflationary rates, we have inflationary rates, for example, in Venezuela as high as 167%. We have New Zealand around 7.3%, right? We do have some economies actually being stable mostly around the Asian economy, like the Japan, Thailand, and China, which still have their inflation still controlled. We have Argentina as well as high as 8.4%, right? But majorly across board, inflation is mostly at the highest in most countries. Like in the US, we have inflation as high as 9%, right? So would
Yeah.
you say when we try to understand how inflation is currently, um, what should our investors or traders be looking out for? Should we just be looking out for the events happening in the Russian and Ukraine issue to tell us, okay, if we are getting any positive sentiments on that front, then we want to believe that inflation numbers will be reducing across board, or should we be looking at some other macroeconomic indicators like is it unemployment, is it the housing starts, or should we be looking out for the monetary policies by major central banks? So if we look at what just happened recently, I think it was last week, the Central Bank of Europe increased their interest rate by 50 basis points to tackle the rising inflation, right? So where should we as investors or traders actually be looking out for to tell us, okay, I think it's now is the time where the markets are becoming bullish, or now the
Yeah.
market is going to remain bearish for a specific period of time. So what should we be looking out for as investors or traders going
Okay.
forward?
Okay, so thank you very much. So on a broad scale, or let me say first that even though yes, there's a lot of inflation, there's a lot of focus on inflation across individual markets. You still have certain nuances specific to those markets that sort of drive their own activities, and I'll get to that. But to sort of answer your question first, of course, other macroeconomic indicators that we should be looking at, traditional macroeconomic indicators. So we're looking at GDP across these economies. What are the prospects of growth? What are the major drivers of these growth, and what are the potential hindrances to growth? We're looking at employment numbers. So, for instance, in the U.S., we know that we've seen jobs numbers improve, but at the moment, the major sort of macroeconomic indicator that I would say the bulk of investors and generally economic watchers are looking at is closely tied to inflation, because that is what has been driving the bulk of the monetary policy decisions that we've seen recently. So from the US, we've seen a hike in the Fed fund rate. Um, in the UK, we've seen a hike in the interest rate as well. And like you mentioned as well, we saw a 50 basis point hike from the European Central Bank. I think that's the first time in the last
Mm,
11 years that we've sort of
mm,
seen that happen. So as we're having inflationary pressures rise, we're having monetary policy authorities increase interest rates, to try to address the inflation concern. The other thing that authorities will be trying to do is ensure that we're still able to, you know, deliver real returns on investment. So keeping their markets attractive enough for investors to come in. Now, more specifically to the markets, and maybe speaking more specifically to the equities market, whilst across the bulk of the global markets, this year hasn't been positive. We've seen a fair bit of sell-offs across global markets this year. When you drill down to Nigeria, for instance, the reverse has actually been the case. So that sort of speaks to the nuances of specific markets that I mentioned earlier. Here in Nigeria, our market is currently up about 20%. And despite all these issues that have been happening, why have we seen the Nigerian markets still remain on the uptrend?
yep.
Um, since 2020, we've seen more of the domestic players play in the Nigerian market because the bulk of the foreign investors exited the market. So what we've then had is investors are looking at the specific companies now and looking at the fundamentals of these companies and saying, okay, what's the current pricing, of this stock, for instance? Is there any potential for upside when you compare it to pricing of pairs, across other markets? So say you're looking at a GT Bank, for instance, you're comparing its price to book numbers and its price to earnings ratios across other sub-Saharan African banks of similar sizes. If you're seeing that GT Bank seems to be undervalued, it would show you that there's that opportunity for upside. And then you're then looking at the financial performance of these companies and you're saying, okay, they're remaining relatively defensive. So that would also let you know that there's that opportunity for upside. So as an investor, this is a time to sort of be more active, take a closer look at the market. So as opposed to just looking at the market on a broad scale. So even in the US markets, for instance, where you might see the benchmark indices reflecting an overall negative return for the year, there would definitely be specific stocks within the market that still present an opportunity for upside. Across the global markets, we know that with the rate of technological advancement that we're
Mm-hmm.
seeing,
Mm-hmm.
there's been a shortage of supply of microchips globally. So as an investor who invests in foreign stocks at the moment, what I would be thinking, especially if I have a long-term view on the market, what I would be thinking is there's a current shortage in supply of microchips, right? What I would be focusing on is let me get like a list of companies that currently produce microchips that are currently listed in the market and try to take position in those companies because the current shortage in supply sort of suggests to me that there's a ready demand for that product, and it means that there's that prospect for growth into the future. That's for global markets. For Nigeria, for instance, 2020, just going back to 2020 again, like I had mentioned, when we started to see a lot of because of the lockdown and some of the restrictions that we had,
Mm-hmm.
we sort of saw like the negative impact on the earnings of companies, especially manufacturing companies. We know that with the lockdown, the 3 month period of lockdown that we had, there was a slowdown or almost
Yeah.
cessation of
Operations.
of operation. So that obviously had an impact on their numbers. But the flip side to that is for a company like for a telco, say like an MTN, for instance, it was a positive period for them. And this is closely tied to the fact that the nature of work changed. So we went from a largely physical work structure across most of the companies to one that was largely remote based. So people working from home, people working from whatever locations they're working from. And that would suggest that would require a lot more of internet usage, a lot more data consumption. And for a company that provides internet services, that's a positive for their own earnings. So I would say that I know that's a long response, but I would say that the summary is then to take a closer look, be more active in the markets, take a closer look as opposed to looking at the broad market. Take a closer look at specific sectors, specific companies within the sectors, and try to see which ones have, like a prospect for growth, which ones tend to be more defensive in nature, and take position, in those kind of companies. And I guess that's where you and I come in, being advisors on, the sort of investment decisions um, that investors should be looking to take.
Yeah. So what our viewers will get from that is now that we are currently in inflationary period. Obviously, the COVID added to the inflationary period where companies were not able to operate maximally as possible. Obviously, there were companies too that benefited from the COVID period, like you mentioned, the
Yeah.
MTN, the technological companies, because most people now went online. So there were opportunities um, to go long on some of these assets, whether you're investing or you're trading, you could go long. And if some of these companies too were also in the bearish market due to the fact that they were not able to operate, you could also go short in this company, right? So what our guest is trying to tell us is that you have to look at investing more of on a sectoral base, on a company base, instead of looking at it from a broader base. Obviously, the Russian and Ukraine issue is one you have to keep your eye on because it's moving in the general market, and we also have some macroeconomic indicators you can also look out for. But and at times like this, is best we look at it from a sectoral base and a more individualistic company in order for you to maximize the best opportunity out there, right? So we also have some other questions we would like you to shed more light on. We also touched about the recent 50 base hike by the European Central Bank, right? And this
Yeah.
has been coming up from about 11 years now. So I'm just going to put up a chart now that will help us get understanding, right? So this is the current trend of interest rates in the US and in the Eurozone. And we can see that the the US have been increasing their interest rates over since the beginning of 2022, from February, from around 25 basis points to now we are around 175 basis points, which they added a 25 basis points, 75 basis points from the last month to their recent month, right? And analysts were actually forecasting that the European Central Bank, which they released their interest rates readings that was last week. Analysts were
Yeah.
forecasting a 25 basis point increase, but we got 50% basis point increase, right? So how does that affect the currency of the country? How does that affect investor sentiment, either in the fixed income market or in the currency or in the equities, right? So how does uh, um, an aggressive hike in interest rate, how does it affect economies, their currencies, and investor sentiments towards stocks in that economy?
Okay. So on the path of the financial markets, especially for investors that are looking to come into those markets, um, it's a higher interest rate, especially for investors who are looking to invest in, some of your financial markets. It sort of makes it, um, there's that attraction for them for their funds to flow in to your market. One of the reasons why you would, be increasing interest rates whilst they're having inflation rates rise is you're trying to tackle, well, you're trying to ensure that investors are still able to get real returns on their investments, and that their investments aren't completely eroded, um, completely eroded by inflationary pressures. So with increased inflows into those economies, it could be a positive for those markets. So with that, we could also see like some strengthening in their local currencies as well.
Okay, so what you're just trying to tell us now is that when there's an increase in interest rates by central banks, according to their policy, there's always a strengthening of the currency, because people will then want to rush into, for example, like the fixed income, and they will need these currencies to make these transactions, right? So
Yes.
when there is a spike, especially just what happened in the 50 basis points by the Central Bank of Europe, the euro actually during that period was strengthening. I think was during the 2 or 3 days period going into the 50 basis point increase. There was a high demand for the euro. Again,
Yeah.
coming to our discussion, if you look at what was happening during the COVID period, we saw for example, the U.S. government pumped a lot of liquidity into the market, which we can tag that as quantitative easing. So they try to
Yeah.
support their company by buying some of these assets from banks in order for them to be enough liquidity. And we saw that during that period, a lot of companies were very overvalued. They did their best run. We have Zoom being one of the highlights and companies during that period. We have, for example, you talked about chip shortage. I think during that period too, we had companies like Nvidia also doing good. We have Apple, we have Microsoft. So a lot of companies really give investors real returns that are going long, right? And now we can see that the market is now in an aggressive bearish state, right? Given the fact now that the COVID is ended, a lot of economies are now feeling that their economies are better able to manage themselves without the
Mhm.
support and liquidity they've given them. So now, is it good to state now that we are in a quantitative tightening period? So what we're trying to do now is to understand the circle in which we are. So we can confidently say we were in a quantitative easing period where we are in an expansionary period during the COVID period, and now we are in a
Yeah.
contractionary period. So a lot of assets will be in a bearish state. So we can actually go short on the right assets. And on an investment level too, there are also opportunities that you can capitalize on. You mentioned the fact of Nvidia, which obviously there's a demand for microchips. So investors can be positioning themselves for some good run when economies start going good. So would you say that right now we are in a contractionary period, and when do you think we will be out of the contractionary period going forward?
All
What
right.
is your
Thank you.
forecast for coming out from the contractionary period?
Thank you very much. So, like you said, yes, we're in a contractionary period where we're seeing the bulk of the global monetary authorities adjust rates upwards. But when we try to dig to the root of the major driver behind this upward adjustment that we're seeing, so it's tied to the fact that we're seeing inflation rise, and the rising inflation that we're seeing is tied to the conflict that's currently going on between Russia and Ukraine. So, on some level, I would say that it's a bit difficult to make a call on where we might see a reversal of this trend because there's no certainty as to how the current situation between Russia and Ukraine is going to go. And as the bulk of the monetary authorities have continued to tie um, the rising inflation numbers that we're seeing to that conflict, it's a bit difficult to make a definite call on that. But we're also aware that regardless of the fact that we're seeing inflationary pressures rise, we're also seeing these global economies try to see what other steps can be taken to tackle um, the rising inflationary pressures. So once we start to see maybe the positive impact of some of that, maybe we could then have some sort of easing or some sort of reversal of the current contractionary stance. But at this point, it's a bit difficult to make a definite call as to when that will be done. But the
Mm-hmm.
truth remains that in every period of uncertainty, there's always an opportunity for gain, right? Investors typically do not like uncertainty. In fact, that's the one thing that an investor would rather have bad news than have uncertainty. At least with bad news, there's there's a clear-cut direction that you can have, and even negative for the economy doesn't necessarily, or negative news for the market doesn't necessarily mean that you as an investor cannot make gains. And I guess that's where companies like yours come in, where you have derivatives, your derivatives trading, where you can either make gains from prices going down or prices going up. So of course that's important, and that speaks to the work that you guys do. Um, but regardless of the overall situation, regardless of the current uncertainty in the market, or in the global economies, there's always that opportunity for investors to still make gains, and sort of goes back to what you mentioned earlier about being more active, taking a closer look at the markets, and trying to be more deliberate about where exactly, focus on the sector, focus on the
Yeah.
company, be more specific about what investment decisions are being made. Because at the moment there's a lot of uncertainty.
Yeah.
And what we would either have is investors looking to go into safe haven assets, so maybe move towards gold or instruments like that, or just hold their funds in cash.
Yeah. So speaking about derivative, because I also heard you talking about, one thing investors do not really like is uncertainties, and obviously in an uncertain market, there are also places too you can make gains from if you're actually being specific about how you make your investment decisions, right? So that just brings me to talk about the current development in the Nigerian derivative space. We've been following the recent development by the Nigerian Stock Exchange on how they can develop the derivative space in the Nigerian market. So we want to see how you can speak to that. What are the opportunities in the Nigerian derivative market? What are your takes on that? Is this something you actually buy into? Is there enough volatility in the Nigerian space to actually attract traders and investors into the Nigerian derivative markets? If you can just speak to our viewers on a brief level about that and to give us some insight on what we should be looking out for in that space.
Okay. Thank you very much. So I personally feel that for the derivatives market to succeed here in Nigeria, there definitely needs to be a lot more. Um, uh, there needs to be an improvement in the current levels of financial literacy, in the sense that derivatives aren't the easiest financial tool to understand, right? And whilst there's an opportunity to make significant gains, there's an equal opportunity of making significant losses. So there definitely needs to be a huge understanding um, of that space. We know that, for instance, you mentioned the Nigerian Stock Exchange seems to be ready to launch the derivatives market. For the last 10 years, they've really been talking about it. And one of the major hindrances that we've had here is the fact that market is not deep enough. So in terms of the availability of funds, capitalization in the market, um, there aren't too many instruments there aren't too many companies, um, listed companies that are liquid enough to create derivatives on. So I'll tell you the major challenge with our Nigerian market. So let's even leave the bit of on this of um, a low level of understanding. Um, of the about 210 stocks that are listed in the market, there are really only about 15 to 20 that are actively traded on a daily basis,
Mm.
right? Um, if we're going to be creating derivatives, are we going to be creating derivatives off of the back of just these actively traded stocks? That's one. Two, the level of volatility in the market isn't particularly great as well. Um, so that could also affect the success of that space. But regardless, we're seeing a lot of global financial markets integration. I know there have been a lot of steps that have been taken towards having sessions on derivatives, trying to educate both markets, especially market players, right? So the traders in the market first also have to have an understanding of how derivative markets work before they can actually even market it to their
Ridiculous.
customers and
Mm.
their investors. But I
Mm.
know that there's been a lot of steps that has been taken,
Mhm.
and I would say that there could be that opportunity for success. But personally, I still feel like it's further into the future, say the next 3 to 5 years,
Mm.
further into the future, at least derivatives for the Nigerian markets. There are a lot of companies currently in Nigeria that are large enough to be listed in the to be listed on stock exchange, but they would opt not to, especially in the manufacturing, in the manufacturing space. There are a
Mm.
lot of these companies across Nigeria that just won't list because they don't they don't necessarily see the importance of listing in the market, and that in itself is affecting the level of liquidity
Yeah.
in the Nigerian market. So it's about making the market more attractive for these companies to want to list. And let's not just have a situation where companies feel compelled to list, maybe
Mm.
due to government regulations or anything like that. The market itself actually needs to be attractive enough for investors to want to list before we get to that point of creating derivatives off of the back of this market. Sorry, I know
So
that might sound a bit gloomy, but
yeah, no, no,
it's
you
my
did.
personal opinion.
Yeah, yeah, that's what I said. I wanted you to give your own personal expert opinions about that because I actually shared some sentiments about that because For a derivative market to really work and be more profitable to traders, we need a level of volatility and we need a level of activity, right? So there are a couple of things that we should see how we can take into consideration, from educating the market more, having more players come into the Nigerian Stock Exchange, first of all, and having a bit more local money. Or now, I remember you also said that the majority of the market now is being controlled by local money, which is a positive to an extent. But if we have
Yeah.
more liquidity coming to the market, we can see the derivative market on the local level being more attractive. And there's still a lot of room to make it work, because, as you said, this has been coming for over 10 years. So I'm guessing there has been a back and forth on making this happen. So it's a good news that it is here. And we'll be looking forward to the development and seeing how best we can capitalize on that market, because the more um, we play in our own local space, like our own companies, the more
Yeah.
our local financial markets become broader and people can tap into it. So to wrap up on a lighter base, I know this week has been a very active one in the global space with regards to earnings. We saw earnings from Goldman Sachs, we saw earnings from Twitter, we saw earnings from Tesla, right? A couple of these companies have released good earnings, even given the fact that we are in an inflationary period. So it's giving a hint on what consumers are actually focusing on. And even given the fact that, yes, people are saying there's inflation, people are trying to be cautious of how they spend their money. It also ties to what you said about being more sectorial based when you're trying to make your financial decision. Because we saw Tesla actually beating their earnings, which actually took their stock from where they were the close before the earnings came out. We saw Twitter doing bad, given the issue with Elon Musk and having to look at their revenue model there, because they haven't been really making money, and they're trying to see how now they can make money on the advertisement space and trying to release better products, right? We also saw Goldman Sachs, which did good in their earnings. We saw Wells Fargo, right? So a lot of companies released their earnings. So there are a lot of mixed results coming out of all. We say we are in an inflationary period, and we have companies still coming out with good earnings. So what would you say led to all this, given we're in inflation period and we still see companies doing good on their earnings?
Okay. Thank you very much. So again, like I had mentioned earlier that we would have nuances with certain markets. So same thing with certain companies. We would have specific nuances that could also be positive for their numbers.
Mm.
So yeah, inflation rates is rising. We have interest rates rising as well. Now, when you
Yeah.
think about that, for a bank, it may not necessarily be the worst thing, because for
Mhm.
a bank who is giving out loans, it means there's a positive on their, that's positive for their interest income. Um, which is why from a financial services company, you might see their own numbers improve. For a manufacturing company, for instance, you might see the negative impact, because for a manufacturing company, so their own interest expense or their finance cost has gone up because they are now paying more um, on their loans that they've taken. They are also having issues of um, um, production costs also rising,
Yes.
coupled with pressures on consumer spending. So we could see a mixed earnings across these different companies. But what we also have to bear in mind is sometimes it's not enough to just look at the numbers and then say we've seen a level of growth without looking at the previous year. So, typically when you're looking at earnings for this year, it's in comparison to the previous year. So we also have to keep in mind that, last year we just had, considering COVID and lockdown and everything in 2020, in 2021, we started to see some return to, normal, to a certain level of normalcy maybe not necessarily a full return. But when you compare the first half of last year to the first half of this year,
Mm.
there's been a higher level of normalcy in terms of business operations, business activities. So there's a higher chance that you would see positive earnings from the first half of this year relative to the first half of last year. Because in the first half of last year, we're having companies just, still re-strategizing and restructuring to see how to operate within this new normal
Yeah.
that we have. But in 2022, we can say yes, there's still COVID out there, but by and large, they've adjusted somewhat fully to this situation. So it's almost expected that naturally their numbers this year um, should be better, or at least their numbers in this first half of the year should be
Mm-hmm.
better, um, should be better than the previous year. So that is sort of like when you say you have the base effect on a particular number um, that you're that you're looking at. So the point I'm just trying to stress is, whilst yes, we may be seeing better earnings this year, we may be seeing revenue growing. There's also that likelihood that it could be tied to the impact of a poorer situation last year, which
Yeah.
was sort of out of the company's control.
Mm.
It was
Mm.
COVID and affecting, the global markets.
That's well said. I know next week also we have couple of earnings too coming out from the tech sector. We have Google, we have a lot of tech companies coming out next week. So it'll be one to watch out for. We might still also have mixed readings, as you said. Manufacturing companies, for example, might have poor earnings. Banks might have some good earnings. So there's always a mix when it comes to earnings, regardless of the current macroeconomic picture we're having with regards to Russia, with regards to rising interest rates, with regards to inflation, right? So those events might impact the general market. But given the fact that we are comparing where we are currently in the on the market compared to the last quarter, so when we are seeing a mix of earnings, it's not something that's unusual. So there are various factors that are playing in they are coming into play here outside just the inflation, so we have some sectorial effect like manufacturing doing good, banks that are doing good. We have Tesla, even given the fact that Tesla had challenges with their China factory, which people were analysts were forecasting that would affect their earnings. It didn't move their earnings. They did good with their earnings, and their revenue actually grew. So it's always a pleasure to have expert figures like yourself come on our show and give us your insight about the global financial market. I really gained value from all the weight of experience you've had, given the global financial market, given your experience on the sub-Saharan Africa, and giving your experience on the Nigerian fixed income and the Nigerian derivative market. It's always a pleasure to have you, and we're hoping to have you come on our show most times. And our viewers also be looking to hear from you to see how best they can understand the market and position themselves. So thank you, Mr. Eronmonsele Aziba. I should try and get your name properly, Eronmonsele Aziba. Right? I'm actually ashamed because I'm from Edo State, but I'm guessing it's the way I speak. But yeah, Eronmonsele Aziba, thank you for coming today. We actually appreciate your wealth of experience. So thank you once again.
All right. Thank you very much for having me.
All right, thank you. So with that, we'll be calling today's program to a close.
All right. Thank you.